Keep up to date with all your favorite small caps. Subscribe to our free daily newsletter featuring investment ideas, breakout stocks, analyst research, and more. Smallcappower.com. Investing ideas and research. The Small Cap Power Expert Interview.
Sprung Investment Management helps clients moderate swings in market volatility through a value investing approach. Aimed at preserving wealth and providing a real rate of return after fees and inflation, they're known for employing philosophies that frequently run contrary to current investment trends. Welcome back, Michael. Please remind our viewers once again about your firm as well as your role there.
All right, I'd be pleased to. Sprung Investment Management is an investment boutique. We primarily cater to individuals, families, endowments, foundations, and so on. It just so happens that the bulk of the money we manage is in family trusts. As such, one of our key objectives really is the preservation of capital, and beyond that, some growth beyond our own fees and inflation. So it tends to be fairly conservative money. We're value investors. We invest for the long term, and so we tend to look more at the microeconomic issues that affect individual companies and their valuation parameters than we do spend time on the macroeconomic environment.
What effect will the ceasing of quantitative easing have on the gold price?
Well, in the long term, I would suspect that it will be positive. The ceasing of quantitative easing is really hinting at the fact that the underlying economies, particularly in the US, are getting strong enough to stand on their own. They don't need the stimulus that was necessary after the financial crisis. With that should come some inflationary tendencies. As the economy grows, we will eventually see wage and cost inflation come into the picture. As such, gold should react positively in that environment.
So what is your outlook for both the Canadian and US equity markets during the next 1 to 2 years?
Yes, we've had quite a ride this year. It started out quite well for both economies, but since then the Canadian market has been hit particularly by the decline in commodity prices, whereas the US market, which did take a temporary hit, has now recovered somewhat. Overall, it really appears that the US is carrying the weight of the world on its shoulders at the moment. It's the one economy that we do see relatively good positive growth in GDP. On the other hand, commodities have been hurt particularly by the slowdown we see in the emerging economies, especially China, the stagnation that is apparent in Europe, particularly now with the slowing down of expectations in Germany. And as a result, the commodity prices have been hurt quite a bit. I expect that it's going to be a period of quite sustained volatility until the economies get back into sync, and that could take some time. Whether that's 6 months or a year, I don't know.
The last time we spoke to you, you provided some insight into the Canadian banking sector. Have your thoughts changed at all in regards to this space?
No, they haven't really. I think it's still a relatively strong sector to be investing in. I think some of the environment that the Canadian banking sector is operating in has changed to some degree. For instance, we've seen the emergence now of the non-viable contingent capital, which I guess Royal Bank was the first to issue, which provides for the fact that if there were another financial crisis, that debt that is issued as non-viable contingent capital will convert into equity. I think this is just an added layer, and what we're going to see is higher capital bases demanded in the banks, which eventually will probably somewhat lower the potential for return on equity to a greater extent. The more equity they have to hold, the harder it will be to earn adequate or higher returns on it. On the other hand, with the recent pullback that we've seen in the markets and the commodities and so on, there is less of a rush to really increase interest rates. And if there was a real fear 6 months ago, it would have been that rising interest rates would potentially cause an increase in credit loss provisions in the bank, particularly given the high debt load of the Canadian consumer. I think to a great extent that has been pushed out a little bit further. Until the economies are showing more strength, there will be less of a tendency of the authorities to raise interest rates too quickly.
So what are the top 3 factors you consider before investing in a particular company?
I think that when we look at a company, what we're primarily interested in is what we suspect that company can earn over the coming business cycle. And by business cycle, we're always looking at buying stocks with a 3 to 5 year holding period. Sometimes we'll hold securities much longer than that, but if we don't want to own them for 3 to 5 years, I don't think we want to own them at all. So in that regard, what we're looking for is what is the potential return on equity that a company can make in that time period. And we want to make sure that the price we're paying on that normalized return on equity is a fairly good price that offers us some downside protection but greater upside potential. So we look for much higher upside potential than what we perceive at the time of the investment the downside in the stock price might be. We don't think we're ever going to pick the absolute bottom price, and we'll probably sell long before the absolute top price is reached. But in any event, so we're concerned a lot about price to normalized earnings, which is also reflected in price to book value, because when it comes right down to it, what are you getting for what are you paying? And so you can sometimes, invest in a company that's got a very high return on equity and pay a very low price to book, so you're doing quite well, but it becomes a little bit less obvious when you're getting a little bit more but paying a bit more, and are you getting enough more that within your investment time horizon that's going to pay back. Even more critical than just looking at the numbers, though, is understanding the business that you're investing in, knowing what the balance sheet of that company looks like. If there is a period like another 2008, 2009, does that company have the financial wherewithal to live out such a period? And in fact, would they potentially be in an advantageous position? I think we are seeing today, for instance, in the oil and gas sector, with the pressure, particularly on junior oil and gas, the weaker companies are the ones that are going to have their assets purchased, or they're going to be forced to sell out themselves. So the stronger players are the ones that are going to survive. So I think those are the primary factors that we look at. And we also have to have faith in management. We have to have faith that management can not only articulate a reasonable business strategy going forward, but they can actually execute as well.
And finally, can you tell our viewers about any particular stocks that you like at this time?
Well, I think particularly today, we would be buyers today of the Bank of Nova Scotia. It is a very large holding for us. It's one of the primary bank holdings that we have. But it's taken a bit of a setback today as they've sort of pre-announced some write-downs they plan to take in the fourth quarter. And I think those write-downs are entirely reasonable given some problems that they've had in the Caribbean and some regions. But more than that, I think people have to look at the banks today and say those that have got newer management in place, the managers want to have a relatively clean slate, and so wherever they can take write-downs at this point in time, probably at the beginning of their tenure is a more opportune time to do it than later. I think it's really just cleaning house to some extent, and looking at the Bank of Nova Scotia in particular, it's not very often that you're able to purchase it for a discount relative to the group as opposed to a premium. In the meantime, the dividend is secure. We're talking about 12 times earnings roughly. I think that it's a very good buy at today's levels.
Thank you for taking the time for today's interview, Michael.
Thank you.
Keep up to date with all your favorite small caps. Subscribe to our free daily newsletter featuring investment ideas, breakout stocks, analyst research, and more. smallcappower.com. Investing ideas and research.